Hey folks, welcome back to the channel. Make sure to subscribe, like, hit that notification bell so you get the most up-to-date videos that we're putting out today. And today we're going to talk about Medicare. Most people assume Medicare costs roughly the same for everyone once you reach retirement. Simple system, one program, same cost. But the tax code has a way of sneaking complexity into places you didn't expect, and Medicare is no exception. Because if your income crosses certain thresholds, Medicare quietly adds a surcharge to your premiums. How nice of them. That surcharge is called IRMAA, the Income-Related Monthly Adjustment Amount. And the tricky part? It's not calculated the same way your taxes are, which means sometimes one extra dollar of income can cost you hundreds or even thousands more in healthcare premiums. So what is IRMAA? Let's break it down. Medicare premiums are based partly on your modified adjusted gross income, or MAGI, from 2 years prior. So if you retire in 2026, Medicare is actually looking at your 2024 tax return. Think of it like driving while looking through the rearview mirror, if you know what I mean. The government isn't asking what you're earning today, they're asking what your income looked like 2 years ago. Now, once income crosses certain levels, roughly about $109,000 for individuals, about $218,000 for married couples, Medicare begins adding surcharges to both Part B and Part D, Bravo and Delta. And these surcharges increase in several step-up brackets. Each step can add hundreds of dollars per month per person. So for a married couple, a single income spike could increase premiums by several $1,000s annually. That's real money. Let's talk about the cliff problem. Here's where IRMAA behaves very differently than the tax brackets most people are used to. Federal income taxes are progressive, meaning if you move into a higher bracket, only the income above that threshold gets taxed at the higher rate. Think of it like climbing stairs. Each step only applies to the portion above it. But IRMAA works more like a ledge than a staircase. Cross the line, even by $1, and the entire premium level changes. So imagine, your income comes in at $218,001. That one extra dollar could trigger the next IRMAA bracket. Suddenly your Medicare premiums jump for the entire year. It's one of the rare places in the financial system where a single dollar can actually cost you thousands, which feels a little like paying a speeding ticket for going 1 mile per hour over the limit. Technically correct, emotionally frustrating. Okay, let's talk about executives and business owners. High-income retirees run into IRMAA more frequently because their income tends to arrive in bursts rather than smooth paychecks. Common triggers include things like exercising stock options, RSU vesting, large capital gains from selling investments, selling a business, large RIA withdrawals, and even Roth conversions. Each of these can push income up temporarily, sometimes by a lot. And because Medicare is looking 2 years back, a one-time event can increase your premiums well into retirement. In other words, you might sell a business in 2024 and still be paying higher Medicare premiums in 2026 and 27. It's the financial planning version of a delayed echo. So let's talk about Roth conversions and how they can be tricky. This is where things get particularly interesting for strategic planning. Many retirees perform Roth conversions, moving money from traditional retirement accounts into Roth accounts so that future withdrawals are tax-free. The logic is sound. Pay taxes now to avoid taxes later, but Roth conversions increase taxable income in the year they occur. And here's the key problem. The IRMAA brackets do not align with federal tax brackets. How nice is that? So you might still be sitting comfortably inside a reasonable federal tax rate, but that same conversion could push you over an IRMAA threshold. Think of it like navigating two different maps at the same time. One map is the tax bracket system, the other map is the Medicare surcharge system. And unfortunately, those roads don't line up. So a perfectly reasonable Roth conversion strategy on the tax side could accidentally trigger higher Medicare premiums, which doesn't necessarily mean the strategy is wrong, it just means it needs to be coordinated carefully. So let's look at some sophisticated planning strategies. For higher income households, managing IRMAA usually comes down to income timing and coordination. Some strategies may include spreading out your Roth conversions across multiple years, maybe harvesting some capital losses to offset gains, controlling some dividend income, and adjusting withdrawal sequence across accounts. Sometimes it even makes sense to intentionally trigger IRMAA once if it improves your overall lifetime tax picture. Because while IRMAA may feel painful, it's often still smaller than the long-term tax savings from better planning. In other words, the goal isn't always to avoid IRMAA entirely. The goal is to control when it happens and why. So, in closing, IRMAA is a perfect example of how financial planning operates in layers. It's not just about investment returns or tax brackets or retirement withdrawals. It's about how all of those systems interact with each other. And for high-income retirees, those interactions can have real financial consequences, because sometimes the biggest surprises in retirement aren't market downturns, they're rules you didn't know existed. That's all I got for today. See you soon.